JEPI versus JEPQ. Which covered call ETF is right for you? Welcome to WealthEchelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control of your wealth journey. Investing in the stock market can be challenging, especially when choosing between different investment vehicles. Two popular covered call ETFs offered by JPMorgan, JEPQ, JPMorgan Nasdaq Equity, Premium Income ETF, and JEPI, JPMorgan Equity Premium Income ETF, provide investors with attractive income and potential for long-term returns. However, both funds have distinct features, making them suitable for different types of investors. In this article, we will explore JEPQ and JEPI in depth, analyzing their growth potential, expense ratios, dividend yields, and risk factors, along with a practical comparison for an investor like Martin, who has a $10,000 investment to allocate. JPMorgan Nasdaq Equity Premium Income, JEPQ. JEPQ is an exchange-traded fund, ETF, that primarily focuses on the Nasdaq 100 index, which is composed of technology-heavy stocks, making it inherently more volatile, but also offering greater growth potential. Unlike traditional ETFs that rely solely on stock appreciation for returns, JEPQ employs a covered call strategy, generating income through option premiums while maintaining exposure to high-growth tech stocks. Given the dominance of companies like Apple, Microsoft, Amazon, and Nvidia, the Nasdaq 100 has historically outperformed broader market indices such as the S&P 500, making JEPQ a potentially lucrative investment for those willing to accept higher market swings. This strong growth potential comes with increased price fluctuations, meaning that while JEPQ may generate higher total returns over the long run, it is also more susceptible to sharp declines during periods of tech sector weakness. However, for investors who can tolerate volatility, JEPQ offers a compelling opportunity to benefit from both premium income and capital appreciation, particularly during bullish market conditions when technology stocks experience significant gains. Additionally, JEPQ maintains a competitive expense ratio of 0.35%, which is relatively low compared to actively managed funds, ensuring that investors retain a substantial portion of their overall returns without excessive fees eating into their profits. Dividend yield and income generation of JEPQ. Covered call ETFs provide high dividend yields by selling options for additional income. JEPQ's dividend yield ranges from 8 to 12% annually, making it attractive to income-focused investors. While JEPQ offers strong potential for returns, it comes with higher volatility due to its tech sector exposure. During market downturns, JEPQ may experience more significant losses compared to broader market ETFs like JEPI. JPMorgan Equity Premium Income, ETF JEPI. JEPI is specifically designed to provide investors with steady income and reduced volatility, making it an attractive option for those who prioritize consistent cash flow over high-risk growth. Unlike JEPQ, which focuses on the tech-heavy Nasdaq 100, it primarily invests in S&P 500 stocks, ensuring greater diversification across various industries, including healthcare, consumer staples, utilities, and financials. This broader exposure helps to mitigate risk as JEPI is less susceptible to the extreme price swings that can occur in tech-focused funds. To generate additional income, JEPI employs a covered call strategy, selling options contracts to collect premiums, which in turn boosts its overall yield. This approach makes JEPI a suitable choice for investors looking for stable income generation with less exposure to market fluctuations compared to traditional stock investments. Growth potential of JEPI. Since its inception in 2020, has demonstrated moderate growth with lower volatility, making it a reliable choice for income-focused investors who want to avoid sharp market swings. Unlike high-growth ETFs that capitalize on price appreciation, JEPI's approach prioritizes income stability over capital gains. However, this comes with a trade-off. Because JEPI sells covered calls on a portion of its portfolio, it limits its ability to fully participate in major bull market rallies. While this means that JEPI may underperform during periods of strong market growth, it also ensures that it provides a consistent return even in turbulent market conditions. This makes JEPI an ideal option for conservative investors who seek steady appreciation without the high-risk exposure associated with aggressive growth strategies. Like JEPQ, JEPI maintains a relatively low expense ratio of 0.35%, ensuring that investors do not face excessive management fees that eat into their returns. This makes it a cost-effective investment vehicle, particularly for those looking to maximize income while keeping expenses low. Over time, lower expenses can significantly enhance long-term portfolio performance, making JEPI a more attractive choice than actively managed funds with higher fees. JEPI's blend of S&P 500 exposure, covered call strategy, and lower volatility makes it a compelling investment choice for risk-averse investors. While it does not provide the high growth potential of JEPQ, it offers a balanced approach with steady appreciation and reliable dividend income, making it a strong option for long-term wealth preservation and passive income generation. Dividend yield and income generation of JEPI. JEPI offers a dividend yield of approximately 7 to 11% annually. This makes it a strong choice for investors who prioritize stable income generation. For Martin's $10,000 investment, assuming JEPI provides a 9% dividend yield, he would receive around $900 annually in dividends. While slightly lower than JEPQ's yield, it comes with less volatility. Performance of a $10,000 investment. To better understand the potential returns of Martin's $10,000 investment, we can compare how his portfolio would perform in JEPQ versus JEPI based on historical trends and reasonable assumptions. If Martin chooses to invest in JEPQ, which has a 10% dividend yield and an estimated 10% annual price growth, he could expect to earn approximately $1,000 per year in dividends. Assuming he reinvests these dividends, the compounded value of his investment after 5 years would grow to around $18,500, reflecting both the high income payouts and the strong capital appreciation potential of the Nasdaq 100 stocks within the fund. On the other hand, if Martin opts for JEPI, which offers a 9% dividend yield and a projected 6% annual price growth, he would receive about $900 per year in dividend income. With reinvestment, his investment could grow to approximately $16,000 after 5 years, benefiting from the fund's steady appreciation and reliable income generation. While JEPQ offers higher total returns, it comes with increased volatility, whereas JEPI provides a more stable growth path, making it ideal for risk-averse investors. Ultimately, Martin's decision will depend on whether he prioritizes higher growth with more risk, JEPQ, or stable income with lower volatility, JEPI. From this simplified projection, JEPQ may provide higher total returns over time, but it comes with added volatility. JEPI remains a steady income producer with moderate growth. Which ETF should you choose? JEPI is ideal for investors who prioritize lower volatility and steady income. It provides exposure to the S&P 500 while incorporating options income, making it an attractive choice for those seeking more consistent returns. This makes JEPI particularly well-suited for retirees or conservative investors focused on generating dividends and preserving capital. On the other hand, JEPQ is tailored for investors who are willing to accept higher volatility in exchange for potentially greater growth. With its emphasis on Nasdaq 100 exposure, JEPQ is perfect for those comfortable with the tech sector's swings. Additionally, it offers slightly higher dividend income, appealing to individuals looking for both growth potential and income generation in a more dynamic market. That's it for today's video. If you found this helpful, don't forget to like, subscribe, and turn on notifications so you never miss an update. At Wealth Echelon, we're all about helping you navigate the world of crypto, investing, and financial growth. Have any thoughts or questions? Drop them in the comments below. I'd love to hear from you. Stay sharp, stay invested, and I'll see you in the next one.